This is number 3. This is lesson number 3 of the acquisition modeling. And in this lesson, I'm going to try to make it quick. Again, I have technical support videos somewhere else. And it seems that I get told that people cannot find these files that are associated with them. They're at edbodmer.com, which I'm a little bit in a bad mood today because I spent years on this thing and I get this thing from Wikispaces saying it's going to be removed. You don't give a crap about that. I shouldn't tell you about that. Oh my God. But I'm going to go ahead and it's hardly worth it. I'm going to have to switch to some other much better, whatever you call this, web, WordPress or something. Will be much better anyway. This bastard. So I'm going to put the files right here. Anyway, I'm going to soon have to stop. I hope this is easy to get all this crap in another website. And I've just wasted too much of your time. I totally understand when you say I ramble and keep going. Now, in this section, let me get my thoughts together again. In this section, I'm going to talk about value drivers, and I want to talk about really this hard part about thinking about returns and growth and interaction. And we're going to do some mathematics this time, and not just talking generalities now. I'm not going to do that on the video. I'm going to do that kind of demonstrate the results. And, we'll look at ROIC and ROIC data. Here's where the videos are, okay, or the files are, okay. We have already talked about this. We already know that multiples are driven by rate of return growth and cost of capital, period. Okay, there's no question about this stuff, but what really is it? Here is this wonderful kind of, I've shown you this stupid kind of thing where you talk about what's your strategy. How does that affect your economic performance? Your strategy is to get monopoly profits and to get a high return on investment, plus grow that once you figure out how you can keep your competitors out. That's all it is, okay? Now there's this business about whether it's a hard thing to really think this return on investment is such an obvious thing. I've talked about it before, but if you don't make expenditures, if you don't gamble, if you don't put any money up, except if you're Uber, it's hard to get money. So we're going to talk first about the case with just a simple constant ROE and show you this formula. That value equals E times 1 minus G over ROE divided by K minus G. Here's what McKinsey, those beautiful people, say. You might go as far as to say that this is all there is. Everything else is detailed, but it's not at all the case. Things change. It doesn't work with inflation. It doesn't work when the current ROE is different than the future ROE. It's a mess. Okay? If everything's constant, okay. If everything's in real terms. Okay? And then they say, well, okay, everything's cash flow. And if you want to look at things like insurance companies, which we will look at, you have to go way, way to the back of the book. Okay, whatever. All right. And for insurance company, you have to somehow make profits on your policies when you sell them. Now, here's where you get really, really, really high PE ratios or EV to EBITDA ratios. Way up here, way, way, way up here. And then they kind of cluster around here, because if you don't make more than your cost of capital right here, along this whole line, it's 1 divided by K. Along this whole line, it's 1 divided by K. Okay? Here, you PEs are the worst. This is the worst case for PEs, because you're growing and you're making bad NPV decisions. That's all there is. This, at least, you are saving money. Okay, enough of that. Okay, we'll show that high ROE create more value by focusing on growth, while low ROE create, okay, whatever. Everybody wants a high return and to grow. You want positive NPV investments. Okay, to prove this stuff, I've done it before, but it's worth saying again. Cash flow is just the next year cash flow divided by K. That's integral from 0 to infinity. If you have growth, it's next year's cash flow, or cash flow 0 times 1 plus G divided by K minus G. Nothing else. Then there's this growth formula that says if you want to grow, you have to retain something. If you pay everything out, you can't grow. So if you have a payout ratio of 100%, your growth is 0. If you have a payout ratio of 0, you grow by your return. The higher your return, the faster you grow. So this is worthless formula. This is completely worthless. But if you rearrange it, put the payout over here, you have 1 divided by G over ROE. And then you say value is dividends, not earnings, divided by K minus G. Dividend payout ratio, we saw from here, is this one. So dividends is earnings in period 1 times dividend payout ratio. So we just plug in or we divide it if you want, divide it by that, and we get, oh shit, this one, I did it right. Okay, this was payout ratio. Earnings times payout ratio divided by K minus G. Divide it by that and you get PE ratio. If you want the book value, you can just say, well, earnings, this E1 is book value times ROE, and you can easily see that you get another ratio. Okay. All this is saying you should make investments when the return is greater than the cost of capital. Everybody agrees with that. There's no issue with that. Now, just to kind of prove this all to you, in an associated video, I went to in a technical video, I had you work through this and prove that the formula works, and let's make the G 4%. And, I better put the calculation on manual, automatic, except for data tables, so we can get these different PE ratios just by putting the formula in. And then instead of wasting a whole lot of time on the Excel, let's look at a couple special situations. When the growth rate is 0, it doesn't matter. You just got basically a bond. It's basically you divide it's like a perpetuity bond, no matter what the return is. So here we have a return greater than the cost of capital and some growth in the PE ratio, whether we use this formula or take the NPV over the really long term, is 22. But when we put 0 growth, we have a return that exceeds our cost of capital, then our PE ratio goes way, way down. So how fast can you grow? How long can you grow by making investments that are positive because the cost of capital is below the rate of return? Then your dividend payout ratio goes to 100%. Okay, but here's the next point. If you start with 20% return, well, so what? You still get the same kind of cash flow forever. It just stays there. It doesn't grow. And then you're just discounting that higher kind of cash flow at the rate, but you're paying for that earnings already. So when you do the PE ratio, it doesn't change. Or you could put 6% and it doesn't change. Okay, now we can do the same thing. This is perhaps, it's not more interesting. It's the same sort of thing. So, you go to this one, and if I put 8% in for the ROE and the cost of capital, I get the same thing. And that's because it makes a lot of sense. It's because when you pretend you have a company that buys treasury bonds. So I've talked about this one before, and all you're doing, you're not doing anything. So when the ROE is equal to the cost of capital, I don't care how fast you grow. I can buy a whole bunch of treasury bonds and give my interest back. The reason treasury bonds work well is because it's something where you finally know the cost of capital. The biggest problem we have is we don't know it, and we're back to this thing. So we have two cases: when the growth rate is 0 and when the ROI equals the cost of capital. Both cases have a PE ratio that's constant, and that's just 1 divided by the K. Okay? Maybe if you could find companies that don't grow, you could almost say, then I know what the PE ratio is if they had 100% payout. Now, this is a kind of corollary to all this. If you're making crappy investments, maybe like my investments in my website, oh God, what a crappy investment that is. the more time I spend on it, the unhappier potentially I get. It's just negative. Okay, so if we grow faster, we get a low payout ratio. If we have a negative growth, we get a higher payout ratio. It's good to close down the businesses when they're not working, even if you like them. Well, I do like this stuff. Now, here's what let's do this next. Let's look around, and I have this insurance company file that I'm going to put up on the website. I hope you see that it's in that M&A section. Is it really that hard to find this? Okay, and let's find some companies and see what kind of conclusions we're going to get by looking at some individual companies. I'm not going to look at insurance companies, so just give me a minute. Let me get the file. Okay, so I opened the file called the beer companies, and we've got some companies in the same industry. I clicked on this one. I said, let's look at the rate of return. I've got the rate of return on invested capital down here. And I put the PE ratio on the top. And we can cycle through some of these companies and kind of see what's going on. Carlsberg had has a 19% PE ratio and a low ROE. Diageo has a higher PE ratio and a higher return. That's all kind of making logical sense. But this return on invested capital is affected by a whole bunch of goodwill that's on the balance sheet. So we have to really look at the future NPV of the investments. It's so difficult to really get this stuff to kind of be nice. Here's Ambev. They've got a high growth rate and a high return. They've got somewhat higher PE ratios then. Let's look at this Molson. 15, a little bit lower than some of these other companies. This, by the way, is the kind of current PE ratio from Yahoo, and these are the ones that are computed. And then they have some high expected growth rate, but a low return. Then we have Boston Beer Company with a higher PE ratio, much higher return, a lower expected growth rate, but at least they're getting that growth rate on a good return. That's the kind of stuff you're supposed to see. But it's got to be incremental returns, and it's really, really tricky. Just to put that formula in is such a dangerous thing. Here, this has got a little bit higher PE ratio. Their return seems to be going up. They have a high growth rate, so maybe you can find a little stuff in here. All right, that's what I'm trying to show you now. So that's a little returns. Now, the next thing, just to kind of keep going through this. Oh, what a ridiculous thing to say. I've said this too much, but if we make a data table, and I'm showing you this from an earlier presentation, it's out here where we have, in this case, we have different lines with different growths and the return. When you get the high return and the high growth rate, it expands. Same here. Okay? And here I just did our little example. Now I put a really high growth rate. Our formula doesn't work here anymore, but we got these exploding PE ratios, and this is exactly when you have to start looking at DCF. Perhaps I'm half talking myself into using the DCF method because these multiples and the difference in these multiples are so different to interpret. There's another one. Now what I did next is went through changing rates, and there's in the accompanying video, of course, you have to do this, and you go through and put in case number 2, we start low and go high because we're making incremental investments that are higher than our return. In case 3, our incremental investments are lower than return, so we have the opposite kind of thing. And in case 1, they kind of bump around. Now we have some moderate growth, some high growth, some low growth. I've changed things around, and even the cost of capital I've changed. And the implication of all of this is when the growth is low, then, okay, if we go and increase our ROE, it does make a difference. But when the growth is high, our case where we increase and make good, better investments than we did in the past is enormous compared to the low growth. These, and then this is the middle one. You can see how the interplay really works, and you can see what you really have to try to figure out is, can they continue to earn high returns? What's going to be their return when they make new investments? It's not to say you should make lower investments because your total value can go up, but the PE ratio is so much influenced by these kind of phenomena. Now I'm going to start looking at growth, and this is this horrible thing I've shown you before where the real growth is supposed to just stabilize at the rate of inflation, and the ROIC is supposed to stabilize at the cost of capital. So out here, your PE ratio is 1 divided by K. There's no variation in the PE ratio. I didn't make this. And growth fades and all this stuff, and you're going to make a likely outcome because you know it's going to be up here and then down here and then up here. Good for you. Okay, but I'm looking at growth a little bit. Now, I made a second technical video, and in the second technical video, I went through I put in the file is called the comprehensive stock price. I can't even remember things. I'm so upset by this. Here's just inflation. When we have growth in our nominal cases, we are including inflation. Here's inflation kind of in the 1970s. This starts with the 50s, and you can see that there's a difference in the two U.S. ones. This is CPI, GDP inflation, and you can then I start later on here. I start in 91 to 2007. You can see the inflation was 2%. Here, since 2009, it has been 1.63%, or 1.46% if you use the deflator. Not much inflation. Okay, we'll talk about that more in the cost of capital, and then you can say, oh, well, if I'm selling beer, here's the way my growth should work. If I sell more beer than the population growth, I've talked about this before, everybody's going to get really drunk. If I sell less beer, oh, that's bad. People won't be happy, I guess. But I'm going to get inflation, and then I can say, let's just look at the population. And this is kind of cool. You can get the world population. Here's the growth rate. The IRR is just the growth rate. I suppose it's reinvesting. I don't know what that would mean. I don't have to really think about that. The growth rate in the population for the world has been about the U.S. 1%. This is since 1950. More lately, 1%. So if you wanted to make a rough growth rate, you could say in the long run, we get our inflation. Maybe this is going to go up. Maybe 1% plus another 1%, 1.5, maybe 3, maybe 4%. That's where to start. And then you can say, no, let's look at Amazon. They might grow at the rate of consumption. So you just click on the rate of consumption instead of looking at stock prices. You can see, since in a nominal terms, without deflating, including inflation, the consumption's gone up by 5%. When we take inflation out, it's about 2%. And here is the one with, since 1990, 4% or 2.67. Those are kind of long-term growth rates. I don't understand how, if people buy stuff and they, okay, well, yeah. Amazon's going to take market share away from everybody. That's after you've kind of figured out what's happening to the industry, then you go to your own. And then I kind of said, well, let's look at the stock market in real terms, deflated. The stock market in real terms gave you about 3%, 0.4% since 1990. It gives you about 5%, where consumption went up by 2.7%. Stock market, that difference in the IRR of the long run is an enormous difference. This is what the mathematics, that should be the theme of so many things. Now let's look at Amazon. Here's what people are saying about Amazon. They're saying it's going to grow by 27%, the earnings. Next year, the revenues, this is from MarketWatch. It's so cool. You can just click on this and get this stuff, isn't it? Maybe you don't like it. And then I can put the revenue growth. So how fast is it going to grow in the future? That's going to be our big task when we get to the corporate model. Now, I took this number and said, well, if you grow by 27%, what does that really mean? If 5 years, if you grow the revenues at the same rate of earnings, you're getting $1 trillion USD, $1 trillion USD. That's what these high growth rates mean. That's a lot. And if you compare this with Walmart's currently, I just saw a television thing where Walmart's trying to do what Amazon is. They're trying to attack them, not surprisingly. This gives you a sense. Can they really continue to earn the returns? It's kind of good to think about whether you get a valuation from this. That's a different matter. Okay, so then we'll put some sensitivity, and I have to pause the video for a minute. Okay, so they try here, and this is a little bit of a formula where you try to say, well, this ROIC is incremental. How would you know that? I don't see how you get that in a forecast. And I talk a little bit about this crazy idea that the ROIC, the return on invested capital in the WACC, can be the same over the long run. Okay, now, if you're using the EV to EBITDA ratio, I just had some discussion and I put this in and I tried to explain things a little bit, but the first thing, it's kind of the same. We have the ROIC, the growth, and the WACC. Those influence the EV to EBITDA, but since EBITDA has no CapEx, but CapEx affect EV, it has no taxes, but taxes affect EV. Interest we can debate about, but the financing can affect the equity value, certainly. You still get the same sort of things. In fact, growth rates, a little bit of a difference. Where's this one? The growth went from 3 to 4, and the EV to EBITDA went from 8 to 10. Here, the return went from, I changed, in this case, the return. The return, no, I didn't. I changed the cost of capital. I increased the cost of capital, and this dropped way down. The WACC has an enormous effect on the EV to EBITDA. And the ROIC has an effect too. So it's this less of an effect. Okay. Now, let's just think about why the problem I didn't show you here is that the asset life has a really big effect. And I have such trouble explaining why you cannot look at an EV to EBITDA ratio and say one company that has kind of short-term investments is the same as another company with really long-term investments. So I say let's compare buying a really expensive car to buying a house, a cheap house, and let's say they cost the same amount. The car you have to replace every few years. The house lasts for a very, very long time. How much earnings do you need? How much EBITDA do you need to get the house versus the car if they're the same price? The car is a whole lot more expensive because I said the house can last 100 years, the car only 10 years. You need 10 times as much money if you have the car because you have to keep replacing the car. That's the kind of basic idea why the EV to EBITDA ratio is such a tricky thing. So what I did here is I changed the asset life from 2, and I put 0 in for the growth rate. Everything else, I made it ridiculously simple. Only evaluating the asset life, and look at the EV to EBITDA. It starts at 46. Notice the EV to EBIT, the EV to NOPAT. Since I put 0 tax rates in, those are the same. They're the same, but this goes from 46 to 75 to 104 when we have a really long term to 120. That the asset life has an enormous effect. Now you can see how all that works when you look at the other technical video. Tax rates, if you change the tax rate from 35 to 21%, you can see kind of how the EV to EBITDA changes here. The lower tax rate pushes it way up. If it's a PE ratio, a forward PE ratio, the earnings are supposed to already reflect the taxes, and the PE ratio shouldn't really change if you've got a forward PE at least. Okay. And then this one, I just put different asset lives in with all the other costs of capital and showed that the EV to EBITDA still has a very dramatic effect when we're having a 40-year asset versus a 10-year asset. Okay? And I've got a couple of other things here, but that's it. I'm going to stop this one. That's kind of a little more technical stuff. Maybe one concluding comment is multiples are really hard. They're really hard to interpret. They're really hard to figure out why one's a little higher than the other. And oh my gosh, you have to. There are interactions. There are what's the incremental return versus the current return. That's why you might look at a DCF method and a multiple method together, and that's what we're turning to next. Okay.